What's up everybody, I am Jaspreet Singh, and there are some investments, your car, that eat up all of your money, and then there are some investments, real estate, that put more money in your pocket. The reason why you invest your money is so you can be financially free and do the things that you want without having to worry about money. But all investments don't work the same. If you really never want to have to worry about money again, you need three different types of investments. You need an investment that's going to pay you with income, you need an investment that's going to give you growth of your wealth, and then you need an investment that's going to protect your money. So what I want to do today is go over the three investments that you need to make, that way you don't have to worry about money ever again, starting with number one, which is investing in real estate for income. Traditionally, when people talk about making a passive investment for income, they talk about investing their money into the stock market, into a dividend paying company. So you look for a company like McDonald's that's been paying a good dividend, you invest your money into McDonald's, and then every quarter McDonald's is going to give you a dividend check. But I prefer real estate rental income, and I'm going to show you why. Real estate is the best place to generate passive cash flow. The way it works is you can go out and buy a property. This can be a house, this can be an apartment building, this can be a mixed use building. You go out and you buy this property, this building, and then you're going to lease it out to somebody else who's going to use your building. So in this case, we'll use a house, and now I'm going to lease it out to this nice person with a mustache, with his wife who has a braid, or as we like to call it in my native language, Punjabi, a gut. This nice couple live in my home. Now, in exchange for them living in my home and using my home, they're gonna pay me $1,500 a month every single month for living in this property. I don't have to do any work after they move into the property because now I already own the asset. I'll give you another example of this. The minority mindset company's office right here is 2 floors, and I pay $4,300 a month to lease our office space. So this is money going to the landlord. I don't really see the landlord ever, but I give him a check every single month, and this is money that he uses to pay the mortgage for this building and put some money in his pocket every single month. The reason why I say real estate is the best place to generate this type of passive cash flow is because, for one, if you do it right, you're going to be able to rent it out to somebody else, and this rent that you get is going to cover your expenses, your taxes, your insurance, your maintenance, your management fees, and it's going to put some money in your pocket every single month. And if you do it right, you can hire a property management company to deal with all the day-to-day work. So if something goes wrong, if the electricity stops working in this office, I could just call up the property manager, and then the property manager will take care of the issue, and the landlord won't even hear about it. So I like real estate because of the cash flow that you can get, and it can be pretty passive. I'll explain why I say pretty passive in just a second, but the second reason why I like real estate is because of the tax breaks that you get as a real estate investor. Now, although I am a licensed attorney, I'm not your attorney, so if you have specific tax questions, talk to a tax professional in your area. But the IRS rulebook gives real estate investors some of the biggest and best tax breaks that our tax code has to offer. I'll show you what I mean. So if I can rent out this home for $1,500 a month, and let's assume for the sake of this example that my expenses are $1,000 a month to own this property. That's my taxes, my insurance, my maintenance fees, my management fees, and my mortgage is $1,000 a month. This means that every single month I get to put $500 worth of profit into my pocket. This is the money that I get to put in my pocket, which means every year I'm putting $6,000 into my pocket. Now, generally, when you make $6,000, you have to pay taxes on $6,000. But because this is real estate, you get a little bit of a tax break. You get to tell the IRS, hey, I made $6,000. This is the money that I put into my pocket. But because my property is 1 year older, I deserve a tax break. So going back to this home, let's assume that when you bought this home, it was $20,000 for the land and $150,000 for the actual house. Now, you will get to tell the IRS that because this property that I bought is 1 year older, I deserve a $5,500 tax break, which means you put $6,000 in your pocket. This is the money that's in your bank account, but you only have to pay taxes on $500. This is your taxable income because you get to take this depreciation expense on your property. You calculate this depreciation number based off of how much you paid for the property, but this isn't paper depreciation. It's a paper deduction, meaning you take $6,000, put it into your pocket, you can spend all this money, but you only have to pay taxes on $500. This reduces your taxable income and your tax rate because your income is less. This is the first reason why wealthy people love investing their money money in real estate because you can make a ton of money and pay next to nothing in taxes legally because the tax code says so. And the second reason why wealthy people love investing in real estate for the tax breaks is because, well, let me just show you. So you bought this home for $170,000. You paid $150,000 for the building and $20,000 for the land, a total cost of $170,000. Now let's assume that you own this property for a number of years. Every single year you rent it out, and every couple of years you raise the rents, meaning you make bigger profits. And then some time goes by and you look at Zillow and you see, oh, I could sell my property for now $1.7 million. Now, this does happen in some instances. Most of the time, you're not going to see this type of exponential growth in just a few years. But if you're invested in a good area where you see growing demand, where people want to be, you're going to see the prices of your real estate go up. So assuming that this property value goes up from $170,000 to $1.7 million, and now you sell it, well, now you have a almost $1.5 million gain, which means you got to pay taxes on $1.5 million. Now, even if you have a low tax rate, because investors get lower tax rates, that's still a lot of money. But real estate gives you another exception, because now what you can do is you can take all of this money, you take the $1.7 million and you go out and you buy a bigger property. Let's assume that now you buy a bigger property with multiple units. I clearly am not a good artist here, but you go out and buy a bigger property with this $1.7 million, and this $1.7 million property is going to pay you with more rent, more profit because it's a bigger property, and bigger tax breaks for your depreciation deduction. But now the advantage not only is that you own a bigger property, but you don't have to pay any money in taxes today. This is called a 1031 exchange. It's called a like-kind exchange. You don't get this in the stock market, but you get this in real estate, where you can flip your property after 1 year. You own the property for a year, you can sell it for a profit, flip it into a bigger property, and pay $0 in taxes today. And you can do this again and again and again, keep flipping properties into a bigger and bigger and bigger deal. And you can do this until you die and never have to pay a penny in taxes on these capital gains. This is what wealthy people love doing with their real estate, because you can just keep flipping into a bigger property every year or every couple of years, whenever you're ready. You can just keep flipping the property into something bigger, and you never have to pay taxes on those gains as long as you do this 1031 like-kind exchange. Now again, make sure you talk to a professional, an attorney, a tax professional in your area, that way you're doing this the right way, because there's a lot of regulations that are involved with 1031, but this is one of the biggest loopholes for wealthy people, because now once the numbers start to get bigger, you just keep adding on zeros and you keep going into the bigger deals and the bigger deals, and now your rental income goes up, which means you have more cash flow to live off of. The key here, for one, is this requires you to buy real estate not for you to live in yourself, but for you to rent out to somebody else, because now this becomes an investment that you're buying for the sole purpose of making money. And second, you have to understand your market and you have to understand the type of real estate that you want to buy. I like residential real estate because this is a innovation-proof real estate. We're always going to need a roof over our heads, no matter how crazy the metaverse becomes, which is why I like residential real estate. We've seen retail real estate get hit so hard because of the digital revolution. We've seen office real estate get hard because of the pandemic and people working from home. Those two will keep going through innovative shifts, and they're going to be changing a lot. But residential real estate, we know that people will need a roof over their heads, which is why I like single family homes, which is why I like apartment complexes. The last thing that I want to say regarding real estate is what determines a property that I want to buy, because a couple things that I look for beyond just a good area, low crime, growth in population, young people wanting to live there. Once I have all that, the other thing that I want to look for is the numbers. And when I say the numbers, a lot of times people get confused when they look at real estate, because they say, oh, I can buy this property for $150,000 today, and maybe in a few years I'll be able to sell it for $300,000. And if they think like that, they'll be willing to overpay for the property because they have their eyes set on the future price appreciation. All they're looking at is how much can I sell this property for in the future. I don't do that. When I buy real estate, I don't care about what's going to happen to property values tomorrow or next month or next year. The only thing that I care about is how much cash flow I'm going to get. So remember, my goal with real estate is cash flow. I'm working to create income. So when I invest in real estate, I don't care about what's going on with property values. What I'm looking for is a 7% cash on cash return on my money. Meaning, for every dollar that I invest, I'm going to make 7 cents in positive cash flow, 7 cents in profit every single year. If I invest $100,000, That's $7,000 a year in positive cash flow. That's what I'm looking for. So when I invest in real estate, remember, you have to understand your goal. My goal is cash flow. Property values crash, okay, I'll go out and buy more. I don't care because this is what I'm looking for. I don't really care about that growth. This is what I'm investing for. And if I do see a lot of growth in real estate prices, well, that's icing on the cake. Now, before I move on to number 2, if you are interested in learning more about investing your money in real estate, I put together a 1-hour-long class on how to make your first real estate investment. You can watch this class for free on our Market Insiders app. It's an investing education app. So if you want to watch my 1-hour class on how to make your first real estate investment for free, I'll put the link to how you can watch that class down in the description below. The second place where you want to be investing so you don't have to worry about money is in businesses. Now, the reason why I say in businesses is because this goal is to give you growth. With real estate, it was cash flow. Here, when I invest in businesses, I'm looking for growth. And the reason why I say growth in businesses is because you have to look at how do you attract money. The more value that you can provide, the more money that you're going to make. Well, when you go out and you buy a home or you buy an apartment complex, the only way that you can really add more value to raise rents is if you renovate the units and if you make the home nicer. But at the end of the day, if the location isn't good, you're not going to be able to raise rents significantly. So you're ultimately dependent on the location, which is why real estate is more of a passive way for you to generate that type of cash flow versus in business, you can invest in companies that are working to produce more value. You can invest into a company that way they can use your cash to hire more employees, to innovate, to create new products, to sell more products, because now the business is actively working to create more value and produce more revenue and make a bigger profit. Now, there's a number of different ways that you can invest in business depending on your risk tolerance. So I'm gonna do it in order of least risky to most risky. The least risky would be investing in the stock market. Now you're investing in established companies. Many times these are companies that are worth billions of dollars. Now, of course, you can see a stock go bankrupt. You can see a stock go to zero, but a stock that is on the stock market is less likely to go to zero than a startup that has less than $100 worth of sales. The second, which is a little bit riskier than the stock market, would be investing into what I just said, a startup. A startup now is maybe you're investing into a smaller company, a company that's working on raising their first million or 10 million or $100 million. You could invest some money into the startup, give them some money, that way they have some cash to go out and grow and hopefully get bought out, hopefully go public. That way you can then liquidate your equity and make some more money. This is what you see happen on Shark Tank, where the sharks, the investors, are investing into startup companies and they're hoping to see the startup companies grow. And then you have the option of investing in your own business. Now, I was really debating whether to put this here or this here because when you invest in your own business, you're investing in yourself. And at the end of the day, you are your best investment, which is one of the reasons why it might not be as risky of an investment. But the reason why I put it here is because not everybody's meant to be an entrepreneur. And you don't always know that until you go out and try to start your own business, because starting your own business is tough. You have to be very disciplined. You have to be very creative. You have to be able to do the things that a leader and an entrepreneur does, which isn't always very intuitive. So that's why I put it here. But another way that you can invest in business is just investing in yourself and creating your own business. The reason why this is so important is because when you invest in businesses, you get equity. Equity meaning ownership, because that is the way that you build wealth in our economic system. Equity is so important because it allows you to monetize on perceived value instead of just the value that you created. So if you go to work every single day and you make $50,000 a year, you only get $50,000 worth of value. You're only getting $50,000. But if you're a company and you make $50,000 worth of profit, your company might be worth $500,000, 10 times the profit, because now the equity, the value of the company is worth a multiple of that profit. So a way for you now to capitalize on this perceived value, this equity game, is by owning a piece of these companies. Now, obviously you can invest in your own company where you work at, or you can go to the stock market and invest in some of these companies. This whole multiple valuation game is so powerful because it allows you to capitalize on this perceived value and allows you to capitalize on the growing values of companies that you believe in. I made a video talking about this not too long ago, but we live in a capitalist society. And in a capitalist society, you can make money one of two ways. You can make money from your labor, which is you going to work every single day, or you can make money from your capital. Make money from your capital is when you invest in equity. It says it in the name. In a capitalist society, the way that wealthy people make their money is through their capital more than from their labor. So what you want to do if you're working to become wealthy is you need to use your labor as leverage to use that money that you earn to now go out and invest in equity. That way you can put your capital to work. So you get your capital from your labor. Now you need to put your capital to work by owning equity in the right companies. That way you can get the growth of all the smart people working hard to grow your companies. And there's 3 ways that you can do that. You can invest in publicly traded stocks, you can invest in startups, or you can invest in your own business. Publicly traded stocks means a company is now on the stock market and anybody can go and buy and sell shares of this company. So if you go and buy 1 share of Amazon, you become one of the owners of Amazon. If you buy 1 share of McDonald's, you become one of the owners of McDonald's. Now you don't get to tell the company what to do with that small of ownership, but you get to share in the profits, because as these companies make more money and their profits grow, well, the share price goes up. If they don't make as much money and their profits shrink and their companies go bust, well, then the share price of the company that you own will go down as well. So there is risk associated with it. You're never guaranteed to make money, but if you invest in the right companies, then you can make more money. Now, the way that you invest is going to depend on you. If you like the idea of studying companies and researching companies and reading their financials, then you can go out and invest in individual companies. I like doing that. But if you're not interested in doing all the research and putting in all the time, then you can just invest in some ETFs, an exchange traded fund, which gives you exposure to a basket, a group of companies. I do this as well. So I have a passive strategy where every week I have money that's automatically being invested into a few different ETFs. One ETF is giving me exposure to the S&P 500, which is the biggest 500 companies on the stock market. Some ETFs, they give me exposure to innovation. These are companies that are more along the lines of your technological startup companies that are trying to innovate and create new products. And then I have some ETFs that give me exposure to emerging markets. These are companies and countries that are overseas that are working to grow there to give me some protection in these ETFs. So in my passive ETF investing system, all I'm trying to do is just invest my money into these ETFs, which give me broader exposure to a bunch of companies instead of me perfectly trying to pick the right company. And then in my active strategy, I'm looking for the right company. When I find a good price, that's when I'll come in and buy. That way I can build my equity. But the whole goal here is for me to just accumulate more and more equity over time by consistently putting in more money. With startups, it's a little bit different. Now you're investing in smaller companies that are trying to grow, that are trying to get some sort of market share. That way they could go on to the next stage of their business. The risk here is when you're that small, there's a bigger chance that you will fail. But if you hit the right one, now you can see an insane return on your money, because if you can find the next Amazon or the next Uber before it becomes Amazon or Uber, well, now you can see a massive return on your money. So higher risk and higher potential reward. Now there's a bunch of platforms on the internet that let you do this. WeFunder, Republic, and Start Engine are just a few. I've invested some of my own money onto companies on WeFunder. They're not sponsoring me. They're not paying me to say this. I'm just telling you some things that I've done. So I've invested some of my own money into a couple companies on WeFunder. I've invested into a company called UpCounsel and a couple others. So I like this type of startup investing because I like entrepreneurship and I like taking on some of this risk and I like seeing these companies grow. But you got to know you. If you don't like that added risk, then maybe this isn't for you. And then you have the option to invest in your own business. So earlier this year in 2022, I separated Minority Mindset from the companies and products that we had under Minority Mindset, one of which is Market Briefs. MarketBriefs.com is now its own company, and this is our daily financial newsletter. We were running this through Minority Mindset, but the problem was I was having a hard time separating myself, Jaspreet Singh, from Minority Mindset, from the products and companies inside of Minority Mindset. That's when I realized that Jaspreet Singh is Minority Mindset, and then I separated the companies like Market Briefs from Minority Mindset. So now Market Briefs is its own company, and I'm investing my own money that I make from Minority Mindset and other places into Market Briefs. That way I can grow Market Briefs and our team bigger, faster, because I believe and I know that our Market Briefs newsletter is the best financial newsletter out there, and I'm working to grow this every single day along with our whole Market Briefs team. But before you go out and just blindly throw your money into your business, you have to first understand the risks and the work that it takes to become an entrepreneur. I know there's been this whole movement of working just a few hours a week with a laptop lifestyle if you're an entrepreneur. It doesn't really work like that. Entrepreneurship is hard. You're going to work a lot of hours. You're going to have to make a lot of sacrifices, and you're going to have to put in a lot of time. And if you're not willing to do that, then I do not recommend you go out and start your own business. Now, going back to the goal here by investing in these types of companies is so you can see more growth in the companies that you're investing in. You want to invest $1,000, that way you can see your $1,000 grow to something a whole lot bigger. Then you can take this new money that you have and you can either live off of this money, or you can take this money, put it into real estate and create more income off of this growth that you created from your stocks. That's the way that I look at this. I don't really like investing in stocks for dividends, especially right now, because if a company is paying out a dividend, what that means is that this company is taking out their profits and they don't have a better place to use this money. They're not going to use this money to go out and buy another company. They don't have a place to take this money and invest it back into their company to grow faster because they're already pretty large. So instead, they take their big profits and they just give it away to shareholders. Now, it's good for shareholders because you get regular checks in the mail, but then that also means that you're going to see slower growth because this company has a bunch of money and they don't have anywhere to put it. So if that's something you're interested in, then you can consider investing in dividend-paying companies, but I rather see my cash flow through real estate, which is why I like real estate income, real estate cash flow more than I like dividend cash flow, and I like the idea of investing in businesses. That way I can see the growth through building more equity in these companies. Third, you want to invest some of your money into real money. And the reason why I say real money is because you want to have a protectionary investment. That way, if the American dollar begins to collapse, if the American economy really starts to go down and real estate prices now aren't worth as much and businesses aren't worth as much, you want to have something to fall back on. This is why I own some physical gold. Gold is your traditional inflationary hedge because gold has been used as real money for centuries, and everybody, whether you're in India, China, Mexico, United States, everybody knows the value of physical gold. So I own some physical gold for that reason. And the new thing that you're seeing a lot of young people move towards is Bitcoin. Now, I own Bitcoin as well, and I buy Bitcoin on a daily dollar cost average system, but Bitcoin doesn't provide you the same security that gold does. Sure, Bitcoin might be the next digital gold. Bitcoin has a lot of potential in the future, but it is not exactly there yet. It's not there yet in the sense of protection. It's not there yet in the sense of security. However, it might be there in the future, but because Bitcoin is just so volatile, you see so many crashes and swings up and down, I wouldn't say that it is your real money the way that gold is. Now, I believe in Bitcoin. I think there's a lot of potential behind Bitcoin, which is why I buy Bitcoin every single day, but I also own physical gold as another way for me to save money. I look at gold like real money. I don't really care about what's going on with the price of gold. I just look at it as a way for me to save some hard money because I understand that physical gold is real money, and if the worst were to happen and I need to pick up and go somewhere else in the world, well, I could take my gold with me and I know that I could convert my gold for another sort of currency or money or whatever I needed to do. So this is my protectionary. I know that gold will provide me with that. Bitcoin will hopefully do the same thing, which is why I'm buying Bitcoin. But this is, if the world starts to end, doomsday scenario, this is my protectionary investment for that. And Bitcoin is kind of that, but it also is a way for me to invest in the new age technology. It's a way for me to invest in the blockchain because I think there's a lot of value in Bitcoin. But again, very volatile, very speculative. If you enjoyed this video and you want to see how you can make your first real estate investment, you can watch this video right over here. And if you want to see how you can make your first real estate investment, you can watch my 1-hour lesson by clicking that button below. Thank you for watching, and as always, keep hustling. If you see that the crime is increasing, that's not a good sign, because when you buy a property, this is something you're owning for the long term.